We've got Sanctuary Wealth Chief Investment Strategist Marianne Bartels and JP Morgan Senior Economist Stephanie Roth here with me on set. Thank you both for being here. Appreciate it. So looking at these numbers, has the Fed done enough? I mean, if you look at the components that fell the most, it was energy prices, which the Fed doesn't have anything to do with, really. So what's your read on this report?
I think we can say that inflation has peaked, but the level of inflation is nowhere near where the Fed wants to be. So they're going to continue to tighten a little bit. And they've been very clear on their message is that they want to get up to around 5%, maybe a little bit higher, and stay there for the rest of the year. I found it very interesting that no one on the Fed FOMC is forecasting a rate cut this year, although the market is forecasting the rate cut. So I think they're going to try to stay as tight as long as they possibly can, because the last thing they want to do is make a mistake and ease too quickly. When you go back to Jackson Hole, Powell said in his statement they were going to keep at it. And I think that was a clear message that he's going to follow the Volcker path. He wants to squash inflation.
Stephanie, we're always looking at this through the prism of the markets, what it might mean to the Fed and various stocks. What does it mean to the average household? Because I know inflation slowed down month over month. That is a good thing. But egg price is still up 11% year over year. Rent price is up. Are these still the type of inflationary numbers that would put the U.S. economy into a consumer-driven recession?
Yeah, it certainly is a challenge for the consumer. And I would say even the bigger concern is the outlook in that with the Fed hiking up to 5% and staying there for a year, it's likely to cause a recession, which is going to be a challenge for consumers because recession likely means layoffs. So people might ultimately lose their job as a result. But the Fed is fighting inflation from the top side. They don't want to worry about inflation getting out of control, so they're likely to stay tighter for longer. And the print that we saw today is consistent with the Fed continuing to hike, even if they do step down to 25 basis points. So a Fed that remains tight for this long is likely to put downward pressure on the economy, and the consumer is likely to feel it in a different kind of way, not just from a price pressure perspective, but now from the perspective that they might start losing their jobs, which is a very challenging outlook.
Yeah, Sozzi is always very focused on the egg prices that continue to
Have to
go
be, Julie.
up
Have
and
to be.
up and up. But it's avian flu, which the Fed can't.
We all eat
there's
them.
only so
We
much
all
the
eat
Fed
them,
can do
Julie.
about that. I want to talk about the market reaction a little bit that we're seeing this morning, because it is interesting that we are seeing stock futures now higher. Did anything change in the outlook from this report, in your view, and why are we seeing stocks react like this, Marianne?
I don't think that there's anything changed. I think this is very technical in nature. In December, the market sold off. We got very oversold technical readings. I think we're working off those oversold. I think as the S&P approaches 4,000 up near the 200-day moving average, I think there's risk that we still go down. I still believe we're in a bear market. The risk is we're still going to come down and test those October lows. And the big question is, will we hold those October lows? And I think a big component that will help us determine that is we're moving into earnings season. The big day is tomorrow with the banks reporting, is where are we in earnings? Because the top-down strategists have taken down their numbers. Bottom-up analysts have not really taken down their numbers. They're looking for earnings to actually increase 5.5% for the S&P. So I think it's going to be very important to listen to the CEOs about what their outlook is for their business for 2023. And we might see adjustments in earnings. But what we've been telling our clients, as long as the Fed is raising rates, that's going to cause volatility in both the equity market and the bond market. And then if you still have to take the numbers down for the S&P, that's also going to create volatility. But we do see a bull running, and no one is talking about where the bull is running.
Oh, well, that's a big tease.
Hey,
go ahead, Sozzi.
Right. Marianne, let me just follow up on that, because what should investors pay attention more now to? What the Fed may or may not put out into the market in terms of language and policy, or is it this earnings season, which kicks off tomorrow with the banks and may not be too good, like you mentioned?
Well, I think the Fed has been very clear on their policy. They're going to stay as tight as much as possible for as long as possible. So I think that message is very clear. I don't think the earnings picture is clear. And I think we really have to pay attention to earnings. But what's very interesting about the market is you have a bear market in a pocket of stocks and you have a bull market already in another pocket of stocks. And the reason why we're not seeing the bull is their market cap is too low. So even though they're rising and many of these stocks are hitting record all-time highs, the decline in the growth stocks is too much it's outweighing what's happening in the value side. And the easy way to look at this, energy we think is part of this new bull run. And energy only represents 5% of the S&P, where Apple, which is part of the growth names, and it's a great company, but expensive, business is shifting, and that represents 6% of the market. So there's a big difference in terms of where the bear is, and the bear has a lot of market cap, it's growth, it's tech, it's FANG. What we're doing is we're repricing those stocks on a PE basis. They just got expensive. You've got to deflate them down. Market is shifting to value. That's where the new bull is, but we just don't see it because their market cap is just not able to compete with the growth market cap.
Interesting. We're going to talk actually to a value-focused investor later in the hour who also has some picks for us. So that should be interesting. Stephanie, when your shop looks at the whole stock versus bond debate, right? Everybody loves fixed income going into 2023. Are you guys in the same camp? And again, does any of that change given what inflation print we got today and what we might continue to get?
No, we continue to like stocks or bonds over stocks. The bond outlook is pretty attractive. You have yields that are pretty elevated. On top of that, you could have capital appreciation. If this recession view plays out, you'll get a decent return in your fixed income. And even if it doesn't, even if we end up in a soft landing, you'll have a nice yield, and you could even get a little bit of capital appreciation with yields falling from current levels. So that's the area of the market that we like the most. And then when it comes to the stock market, we're a little bit more selective. So like Marianne just said, smaller cap is interesting today. Their valuation is at a more attractive level. And that's the area of the market that we would be putting money to. So it's certainly core fixed income. That's the most attractive part of the market for us today, especially given our outlook for challenging road ahead, especially on the earnings front. And then small and mid caps.
I love you were almost literally pounding the table on that train to use a well-worn phrase. Soz?
Stephanie, I'll follow up on that too as well. Within your outlook for stocks and fixed income, when do you see the Fed cutting rates, or do you see any rate cuts this year?
We expect rate cuts in the fourth quarter of this year. We expect recession to hit around the third quarter. So we expect about a quarter lag for the Fed to be convinced that inflation has come back down. And then we expect cuts in the fourth quarter.
Marianne, you said in your notes as well that 60-40 looks good again, which kind of fits in with what Stephanie's saying about fixed income coming back and being a part of the portfolio, right?
Absolutely. So 60-40, 60% stocks, 40% bonds is a traditional asset allocation that is used. And we've said 60-40 is back. And it was never going to be an easy path going from the zero bound to getting interest rates again. But we've been through the pain. The bear market was last year in bonds and stocks, which is very, very rare. And we think this year, yes, bonds are going to do very well, probably even better than stocks. We would agree with that. But we think eventually stocks will bottom out and rally this year. I think you're going to have a bull both in the bond market and the equity market. But what people are also not talking about is you can also now put cash in a portfolio. So you can really use stocks, bonds, cash, because even cash is yielding higher than some of the bonds.
Yeah.
So asset allocation is back.
All right. On that note, a hopeful note here to end it. Thank you so much, ladies. Appreciate it. Sanctuary Wealth Chief Investment Strategist Marianne Bartels and JP Morgan Senior Economist Stephanie Roth. Thanks to you both. Really appreciate it.